Guys, there are finally some stocks, some quality stocks that, in my opinion, are too cheap to pass up here. This is an opportunity that everyone says they wait for. What do you hear all the time? I can't wait until this stock dips. I can't wait for a crash. I have cash on the sideline. Then when the stock finally starts dipping to the 200, 300-day moving average, everyone is looking for the bottom. They don't want to buy in because they want to be reassured that that is the exact bottom. That is not how to make money in the markets. Anyway, in this video, I will be going over some stocks that, in my opinion, right now are too cheap to pass up. I've been keeping you updated all along this whole saga, from when we hit all-time highs to why I thought we would hit a correction in the near term, why I thought that if you have short-term positions, it's a good time to exit the market. If you had high beta, high risk stocks, it's a good time to exit the market, and why I'm now considering buying back in on a few stocks. Remember, we want to be selective here. So in this video, I'm going to be giving you obviously some of these stocks that I'm looking at, but also keep you abreast of what to watch out for this week, because this is one of the most important weeks in the market, and we have so much to get into, guys. Everything will be timestamped below because I respect your time. Let's get right into it. So let's take stock of the overall market at first. If you follow me on X or on YouTube or both, you know that this is a major level that I was looking at. What is the significance of this candle here? Well, first of all, the S&P 500 is at the 200-day moving average right now. But moreover, this candle is November 5th. What was Tuesday, November 5th? This was the election. Remember, we looked at the inauguration bounce. We are now looking at the election. This right here is why I thought that from my last video when I told you guys that we may see a temporary bottom here. It's because this is when Trump got elected. And in my view, I thought there would be some softening of the tariff talk, which we deemed the Trump put, or which the market media deemed the Trump put. I thought that we would see some softening of the tariff talks here, and we did, which gave us a little bit of a bounce on Friday. But stopping at this level here is not a coincidence. The market right now is in a wait and see moment. The S&P 500 down 7% from all-time highs. The NASDAQ actually hit a correction. More on that later. Now, if you guys recall, one of the reasons that I thought we might hit a correction among a wave of data that I went through is the fact that obviously this is now another Trump tariff war. We've seen this, a very similar thing in 2018. However, it wasn't imposed on our neighbors like Canada and Mexico. At that time, it was deemed the China-US tariff wars. However, these tariffs right now are way more punitive towards our neighbors, not just China. But what I was saying was 2018 was such a volatile year that we did get some very violent bounces, 2%, 3% days, and every single time the narrative was the same. Oh, the fears are over, right? Only to then drop some more later in the year because there was a wave of uncertainty. Now we are dealing with high rates. We're dealing with the Fed. Are they going to cut? Are they not? But whether in 2018, where we had a correction, and in 2022, when we had a bear market, we see some extremely violent bounces off of major moving averages. Now, the reason that is because bad news just starts getting priced in. There isn't more, it becomes an exhaustion, right? The market becomes exhausted from the bad news. There's only so many times you can bring up tariffs. So unless there's something brand new, the market just gets this fatigue from the negative news headlines, and then you tend to see these bounces from major moving averages, major levels. And in my opinion, this could be the first area that we see some form of bounce here. Not only are we at the 200-day, but this is also the election candle. Also, if you look at the VIX over VIX 3M, what is this? I've talked about this before, but it's the current VIX, the current volatility index over the 3-month VIX. Usually the 3-month VIX has a higher reading than the current VIX, because when you don't know, the more you don't know, the higher the volatility is. So usually the VIX 3 months out is reading higher than the current VIX. However, when the VIX over VIX 3M is above 1, it means the current VIX is above the VIX 3 months ahead, meaning so much volatility is being crammed into the right now that we tend to get these oversold conditions. However, in terms of data, what do we have upcoming this week? This is why I said this is one of the biggest weeks in the market. So last week we had a bunch of unemployment data, right? And unfortunately, the unemployment rate came in higher than expected. The unemployment rate came in at 4.1%. Over versus an expected 4%. We already talked about how the Trump administration and the Treasury are trying to bring down yields. And so we're seeing obviously mass layoffs. We're seeing a cutback of spending. We're also seeing the Treasury not issue any more treasuries because they don't want to flood the market with treasuries and they want to bring yields down. Remember, we said if there is a high demand for treasuries, that tends to bring yields down. And one way to generate a high demand for treasuries is not to issue more than you announced. So if the bond market investors are like, oh my God, there are not going to be any more treasuries, these things here are paying 4.5%. We better grab this yield while we can before it goes away. That is going to bring yields down the more that bond investors pool into the available supply of treasuries. So with that said, we are expecting the unemployment rate to keep going up, but hopefully doesn't go up so much that it ends up causing a recession. But right now, the bond market is not pricing in inflation fears. Right now, the bond market is pricing in recession fears. So before I get into what economic events we're going to be looking at for next week, I'll tell you why that is. If you look at the GDP now, this has tanked from being over 3% just a few weeks ago to over 2% to now dropping all the way down to almost negative 3% expectations for GDP in Q1. If you look at the Trueflation data, which this has been, I would say, more accurate than CPI. So even at the time when they were telling us CPI was 9%, Trueflation was forecasting double-digit inflation. And right now, when they're telling us that inflation is 3%, if you look at Trueflation, it's telling us that inflation has actually slammed down to a 1.4% growth rate as opposed to a 3% growth rate. This doesn't mean inflation is coming down. This just means inflation is growing at a lower rate than what CPI is telling us. And if you look at the 10-year yield, we went down from 4.8 all the way down to 4.1. We have now climbed back up to 4.3, but I think we will get rejected here as long as the Trump administration and the Treasury continues these policies that we've been discussing. I think this will form a head and shoulders and eventually continue to come down below 4. Remember, this is the first time in history that the 10-year has been higher 100 days after a Fed rate cutting cycle has started. So what data to watch out for next week? Here's the data to watch out for next week. Remember, last week was the big unemployment week. This coming week right now is the big inflation week. So we have JOLTS job openings, the last of the jobs data at 10 a.m. But then we have core CPI on Wednesday, March 12th at 8:30 a.m., followed by CPI month over month and CPI year over year. The next day, Thursday, March 13th, we have core PPI month over month, as well as PPI. And then we also have unemployment claims for the week. And then on Friday, preliminary University of Michigan consumer sentiment and inflation expectations. So those are the really big events for next week. And right now, what the market wants to see is they want to see inflation come down, because if you have unemployment going up and inflation going up, that is a recipe for disaster. That is what the market refers to as stagflation. And remember how I told you that when Trump got elected, it's going to be a game of chicken between Powell and Trump? That is exactly what is happening right now. Jerome Powell last week said that the Fed is waiting for greater clarity on Trump policies before making a next move on rates. But if the Trueflation data is correct and the inflation rate is actually lower than what the CPI is saying, and the next CPI, which is this week, reflects that inflation is actually lower, then the Fed will likely have to cut sooner than expected. And right now in May, it's a 50-50 toss-up whether the Fed cuts or not. And I think, in my opinion, if inflation does come down, and we will see that unemployment percentage tick higher because the government is laying off mass workers in almost every department, then I think we do get a cut May 7th, a lot sooner than what the market had projected at the beginning of this year. So in terms of whether the market will bounce from here, I think that the market can see a couple days of bounce from this major level here. And obviously I don't work for the administration, so I don't know how soft they're going to try to talk this wave of next tariffs, whether they're going to delay them or not. But for sure, right now, this is the level that the Trump administration is definitely looking at in the market. So in my view, the market can see a few days of bounce, but I do think that we are going lower. There are a few reasons for this. I think we're going lower, and I think the S&P 500 finally hits correction territory, and we likely hit the 300-day moving average. Now, the reason I think that is because the Trump administration and the Treasury are telling us that. They're being very transparent about where their focus is right now. Trump actually said, we are not even looking at the stock market, which is true. But if you look at what Besson said, he said in 6 to 12 months, it becomes Trump's economy. This means they're going to be attacking yields, and whatever they're doing now is actually working, even though it is putting a lot of stress on the economy by letting go of hundreds of thousands of jobs, as well as limiting government spending, which in general is probably needed. But doing that at a very fast pace is what is slamming the yields down, which are now, the bond market is now telling us that they're pricing in a recession. But for sure that they want to bring the 10-year yield down, and they want to force the Fed to cut. They're going to try to force the Fed off of neutral. And his exact words were, he being Trump, are focused on the 10-year Treasury and what is the yield of that. So monitor the 10-year Treasury, and until that is brought down to at least the level that it was when they first started cutting, when the Fed first started cutting, the 10-year Treasury was 3.6 right here. Monitor the 10-year and wait for the Treasury to get to at least that before looking towards the White House to see if they're going to be changing their stance. Of course, along the way, if the stock market gets so bad, they're going to try to mitigate this by releasing soft language, still attacking the 10-year. If the market sees a bounce, then they're good. If the market then retracts and gets worse, then they're going to try to soften the language. It's going to be this tit for tat messaging here. But in my opinion, if the policy is going to be, we have to slam yields down by putting the pressure on economic growth, it is very hard to see a bottom for stocks in that environment, in my opinion. Although, as I said, my conclusion is that we will see a few days of bouncing here. All right, so what stocks am I currently looking at? What stocks do I think are just too undervalued to pass up here, too cheap to pass up here? And by cheap, I don't mean price. I've been staying extremely patient in this market. If you guys are part of the Traveling Trader investing and trading floor, you know that on January 29th is when I sent out my warning about an upcoming correction. You can pause the screen and read this for yourself. It is old analysis now from January 29th, a month and a half ago. But this is the type of analysis that I provide below. Obviously, you guys know I try to also keep you updated in these videos. But the stocks that I talk about here are going to be some of what I'm looking at. If you want everything that I'm looking at and you want my analysis up to date, make sure that you sign up and join us below. You can trade with me live every single morning. If all you're interested in is the long-term analysis and the stock picks for the long term, none of the option swings or day trades, there is a much more affordable tier below as well. And I put this post on X showing my year-to-date portfolio gains on both of my main portfolios. Both of them beating the market, both of them green at the moment, not sustaining the drawdown that we saw as a result of the violent correction that the NASDAQ gave and the almost correction the S&P 500 gave. And right now, I'm ready to start deploying some cash here. Now, I want you guys, before I share with you the stock picks, I want you guys, or the stocks that I'm looking at that I think are too cheap, I want you guys to understand something, right? Especially the newbies. Most of you experienced people know this, but every time I talk about a stock that in my view right now is undervalued, I always get the question, but should I buy it now or could it drop further? That is not your job as an investor. Your job as an investor is to find things that are truly undervalued, not just, oh, this dipped a little bit in price, so I'm going to buy the dip. Oh my God, it keeps dipping. I'm going to buy the dip. That's not what I'm talking about. Buying the dip is fine. Dollar cost averaging is fine. But when I'm talking about looking at a stock's valuation and compared to not only the market, but compared to itself historically, the stock right now hasn't been this cheap in 5 to 10 years. It does not matter whether that is the bottom or not, because at the end of the day, you never know if the White House is going to shift policy, if the Fed is going to shift policy. You have no control over that. What you have control over is doing analysis right now and actually recognizing that something that you want to own, that you've badly wanted to own, is more discounted now than it has ever been or that it has been recently. That is all your job is. Your job is not to say, oh my God, I knew I said that I would buy the dip on Amazon if it got below 200 and now it's below 200, but I'm afraid it will go down. That is why you always end up never buying the dip and buying the highs and then being in a position where you're like, oh my God, I bought the highs. Now we're down 12%. Should I sell because I bought the highs? You want to reverse that role. Okay, that's just a little bit of a maybe annoying preamble, but it needs to be said. So like I said, even though I think that the market is going to eventually go down further, the NASDAQ is currently in a correction. And if you bought the NASDAQ and or the S&P 500 every time it pulled back 10%, and that's all you did, you would be a rich MFer when the market does eventually rebound. So I make a habit. I only dollar cost in the indices if they are down 10% or more. Right now, QQQ NASDAQ is down 10%. So in my opinion, based on my rules, this is an add point for the long term. All right, a stock that in my opinion is too cheap to pass up is Google. So Google's sitting at the 300-day moving average. This is a stock we already bought into a few days ago when it hit the 300-day moving average. But 300-day moving average. However, if we dig deeper, I want you to look at something. Right now, Google's PE ratio is 22, right? The industry median is 26, but more importantly, let's compare it to itself. If we look at it compared to itself, its forward PE is 19, which is less than its 3-year average forward PE of almost 24. And its 5-year average of almost 25. So compared to itself, Google is right now more undervalued than it has been in a very long time. If we dig under the hood and look at some of its financials, here's its gross profit growth in the last 10 years. December 2015 started at 46 billion, and you could see the progression: 55, 65, 77, 89, 97, all the way up to its current gross profit of 203 billion. Same thing for its operating income. Obviously, same thing for its net income. You could see its net income growth growing drastically from 16 billion in 2015 to 100 billion right now. What about its cash position? Google has surprisingly snuck into the $100 billion cash from operations tier, which is usually reserved for companies like Apple. But if you look at this, Google 10 years ago started with 26 billion in cash from operations, currently sitting at 125 billion. Now, a lot of you guys will say, oh, but ChatGPT is going to make Google obsolete. First of all, search is only 50% of the money that Google brings in, right? I might do a larger video on this. But secondly, if you think about this, the use cases that you'd use search for Google and the use cases that you'd use ChatGPT or other LLMs for are very different. So when you are looking at search in Google, you're usually looking at local searches, right? What is a good restaurant? Where is a good place to get your car detailed? As well as things like product searches, right? What are the reviews on the iPhone 16? In my opinion, these types of searches are the searches that are the most ad heavy, right? This is where Google makes its bread and butter. If you ask Google, for instance, how many species of dinosaurs were there? This is not really information where a user would look at that and be compelled to click on an ad, right? So asking ChatGPT more knowledge-based questions is what right now LLMs and ChatGPT, what the use case is a lot better for, is for asking knowledge-based or asking it to do certain calculations, right? Like you can ask ChatGPT, run a discounted cash flow model on Google, and it will do the entire thing for you, as opposed to Googling how do you do a discounted cash flow model, and then getting that information and then having to calculate a discounted cash flow model, right? ChatGPT can calculate it for you, but those aren't the types of searches that usually lend itself to serving up ads that a user will click on. A user will usually click on ads relating to a service or a product that they are looking at. And if in that use case, you are not using ChatGPT to tell you what are the reviews of this new monitor or this new computer. You're still using Google. You're not using ChatGPT to say, what is the best Thai food that's around me? You're still using Google. And those are the types of results where a user might click on an ad if, say, the local Thai restaurant is at the top search because they paid for that spot. That's how Google makes money. So in my opinion, I don't think that it's an either or scenario between Google and LLMs. And also, we're not even talking about the use cases that Google has in the pipeline that are not search related. Its cloud business is growing like crazy. If you look at its other category, right? So Waymo, that is growing exponentially right now. Like I said, maybe I'll do a separate video if you guys want me to on Google, but we went from 10,000 rides to a year later doing 150,000 rides, and I believe they're over 250 or 350,000 weekly rides right now. So in my opinion, when you look at Google's growth numbers, there is no sign of slowing down here. And they are diversifying like no tomorrow. Plus, in terms of the search thing, just one thing to throw back to, YouTube is the second most used search engine in the world, the first being Google. So they own two of the top search engines. Yes, obviously now people will use LLMs for something. But like I said, those use cases to me don't lend itself to really ad-based searching. And in my opinion, YouTube isn't going to be replaced by ChatGPT. Now, Amazon is not as cheap as Google, in my opinion, but it is cheap relative to its history. So Amazon typically does not trade at this low of a PE. Its 5-year average forward PE is 54, currently trading at 32. Its 3-year average forward PE is 49, again, currently trading at 32. Currently dropped below $200, almost touched the 300-day moving average, which historically has been a great buy point, obviously, for Amazon if you knew nothing else. Is Amazon a growing company? In the last 10 years, went from 35 billion gross profit annually to now 311 billion. In terms of the cloud-based business, yes, its AWS sector is obviously impressive, and it is industry leading as well. Its cash from operations is also just as impressive as Google, if not more. Starting in 2015, it started with a $12 billion cash from operations, ramped it up all the way to $115 billion. So although Amazon could be a little bit cheaper, again, if you compare it relative to its history, Amazon hasn't traded this cheaply, making that much money in a very long time. All throughout 2022, all the way back to, if you go to 2015 to 2022, it traded in the hundreds in terms of its PE ratio, right? Sometimes in the high 80s, high 70s, but it hasn't been in the low 30s in a very long time. And its position right now is the strongest that it has ever been. Now, even though I think the semis could lead the next bear market, and I've talked about this before and I'll show you why again, I think that Nvidia right now is too cheap to pass up. This one is one that hasn't traded at this level in a very long time. 28 forward PE ratio, lower than its 3-year average of 71. Its 5-year average is also around 71. Its current PE ratio is 38. Now, with regards to the chip industry, it is definitely at the next frontier of innovative change. We know that AI is going to be the next frontier, just like the internet was the next frontier when we were back in the 90s. So there's going to be these ebbs and flows, these booms and bust cycles. AI is not a bubble, but it does get to bubbly levels before needing to reset, figure out where are we in the industry right now? Can we build things that make money on the current infrastructure that we spent money on? The answer will undoubtedly be yes. And when that answer is yes, then the spending will ramp up again as things become cheaper and more companies are able to engage with AI and build their own AI services. So one of the scariest charts in the market is SOXX. This is the semiconductor ETF, because This right here is the August 5th level right here. And it looks like we are now below all three major moving averages. A bunch of death crosses formed here. This has not bode well for chip stocks. If you look at 2022, chip stocks were hurt disproportionately compared to the rest of the market. And it looks like we are on the same trajectory now. So in the SOXX index, you do have Nvidia, Broadcom, Texas Instruments, AMD, etc. And this does not look great here. There can be a crisis averted if we stay above this August 5th level on SOXX of 193. But as of right now, this looks like if we do hit a correction and or bear market, chip stocks will likely bring the market down and will fall disproportionately in the same way that it did in 2022. This is one of the reasons that I was extremely cautious at the end of January, raising an amount of cash that I haven't held in a while, is because of this chart here. So I do think that if that happens, if we don't hold this level of 193 on SOXX, the rest of the chip stocks are going to fall, including Nvidia, and we can see Nvidia back in the double digits. But that does not betray the fact that Nvidia currently is cheaper than it has been in a very long time. And if I told you just a few weeks ago when Nvidia was at 153, if I told you that you'd be able to buy Nvidia at 108, you'd be like, oh man, I would sell my house and my wife's wedding ring to buy Nvidia at 108. Yeah, all right. Well, it hit 108. Now, there's an obvious support level on Nvidia right here, which is at around 90. What was this low here? At around $90, right? This was the August 5th low. So I do think that that could be a major support area. And I do think it's very plausible once the market does, in my opinion, as I said, I do think there will be more selling off until the administration shifts policy. I do think that that is very plausible and would be the next level that I would start buying Nvidia at after this 300-day moving average. Remember, you want to space out your buys. You do not want to buy the dip too often. You want to space out your buys because it needs to create a dent in your cost basis. If you buy the dip every week, you're not doing anything. You're just buying at around the same price point. You need to make a dent in your cost basis. If you buy at 109, your next buy, in my opinion, needs to be 90. Your next buy after that would maybe be this 75 level here. You don't want to just buy the dip blindly. You want to look at a chart and pay attention to it. And obviously, I'm going to be sending out my alerts up to date in real time. Now, I'm going to get asked about AMD, right? All money disappears. I am still of the belief that AMD will hit close to that $60, $50 range. I do not think AMD is going to stay here. Now, we will see bounces, and I actually tried to long it last week for a short-term bounce. Ended up de-risking that at minus 15%. But I do think that AMD is going to continue to drop. I don't think AMD is cheap. Everyone thinks AMD is cheap because it hit $230 and it's now trading at $100. That does not mean it's cheap. Let's look at AMD here. If you look at AMD, its PE ratio is still 100. That's insane in this environment of high beta punishment. AMD does not have a strong cash position. Yes, its cash position is growing, but comparing it to some of the other stocks that I talked about, comparing it to Nvidia, AMD is still generating $3 billion from cash. That is not, in my opinion, enough to justify 100 PE valuation. If not in this environment, right? In a bull market, sure. Now, its revenue growth has been impressive relative to itself, right? But obviously, we're not even in the same stratosphere as, say, a Broadcom or an Nvidia. But if you look at its net income, right, what it actually doesn't make money. If you look at its net income, you can see that its net income is really pretty stagnant here. So we went from in December of 2020, right? We went from 2.5 billion net income to 3 billion to 1 billion to 800 million to 1.6 billion. It's not that impressive of a growth story from a net income perspective. Now, I know that it's still a growing company and it does have a bright future, but in my opinion, these types of stocks are not too cheap to pass up. And I do think, unfortunately, is a stock that is a sell the rips or short the rips type of stock. And my next short level is if we hit this 106 level, that is where I'm eyeing a short. And this is something that I sent out in the Discord too. If you look here on March 3rd, I said another swing short that I'm looking at for AMD, waiting patiently for it to play out now. It's at that 106 level. Now, Tesla, in my opinion, yes, it's sitting at the 300-day moving average. For me, Tesla is a sell cash secure puts type of stock here because it has been so beaten down that puts right now are so expensive that if you sold cash secure puts, you can actually make a good amount of money while waiting for it to dip, right? This is where it's advantageous to start selling puts on stocks you want to own. Now, I still think without any of the AI drivers, Tesla is a very expensive stock, in my opinion, right? It needs to obviously show and prove that it could put robo-taxi on the road. It needs to come out with full self-driving, full autonomous self-driving. Just based on its car business alone, Tesla is a very expensive stock here. So if you take a look at cash secure puts, let me open my public account real quick. Currently, Tesla's trading at 262. However, you could sell the 200 cash secure put expiring April 17th for $410. If Tesla is not $200 or lower by April 17th, you keep the $410. If it is, then you are assigned 100 shares of Tesla at 200 minus 4, which is 196. It really is going to be 195.90 because minus 4.1. But you'll be assigned 100 shares of Tesla at 195.90, currently trading at 262. 195.90 is, well below this gap here, which I was eyeing, this 220 gap here, which I was eyeing on Tesla. If you have a higher risk tolerance, you can go higher on the puts. You could sell the 220 puts for 720. This is a great way to not only get Tesla at a cheaper price if it drops, but make money while you're waiting if you are still on the fence about investing in Tesla here. Remember, on this channel, I told you that Tesla typically has these cycles where it does not really rally until April and May. We saw this in 24, 23, 22. April, May is when the beating up of Tesla typically stops and where we tend to see a rally into the summer. So in my opinion, we do have this big honking gap here between 220 and 240, and I think Tesla will eventually fill that. So right now for me, Tesla is sure you could buy it at the 300-day, but also a very advantageous stock to sell puts on. Now, those are just a few of the stocks that I think are too cheap to pass up. Hopefully, I gave you an idea of how to look at this. I really am trying to keep you guys updated as best I can throughout this whole mess, and I think we've done a pretty good job. If you want my most up-to-date analysis, my full list of stocks that I'm looking at on a daily basis or on a weekly basis, make sure that you sign up to the Trading and Investing Discord below, because that is where I send out all of my buys, my analysis, my day trades, my swing trades, etc. And I go live every single day at market open. Now, I'm going to be getting questions about, should I sell calls against my shares? In my opinion, I think that you missed the boat on hedging here. I think that the time to hedge is on rips. You cannot hedge on the bottom of a interim rally or the interim bottom of a potential drop, right? You cannot hedge at that level. There's no money in hedging there. You want to hedge when call values are exceedingly high, and you need a violent bounce for you to then be able to sell calls again against your shares. And you need the VIX to drop as well so that you can engage with the VIX in the ways that I've been telling you about on this channel, which is right now when the VIX gets to that 14, 15 range is when I look to buy the VIX 2 weeks out at the money. And we've been able to make a good amount of money on that hedging as well. But hopefully you think I've been doing a good job of keeping you guys up to date and keeping you guys on your toes and reactionary as it relates to what is going on currently in this crazy volatile market that we all knew was going to be volatile in 2025. Let me know down below, what are you buying? I love to hear from you guys. Tell me what it is that you think is too cheap to pass up, what stocks you think that I should be looking at as well. Sign up below if you want to trade live with me every day at market open. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.